Okay, our speaker today is Tufts and EMVS's very own Mathew Lee. Mathew graduated in 2018 in International Affairs and Environmental Studies and stayed on an extra year to finish his master's. Mathew currently works for Morgan Stanley Capital International, where he focuses on climate and energy-related research. And today, Mathew is going to help us navigate the word salad surrounding climate-conscious finance and sustainability in the private sector. I'm excited to hear about this for my own financial education and also to understand how the private sector can help deliver the energy transition. So welcome back to campus, Mathew.
Thanks, Andy, for that introduction. Great to see everybody. Great to be back. Not that long ago, I used to go to these at Lincoln Filing and enjoy the pizza on Thursdays. So yeah, it's a weird feeling of deja vu for sure. I was asked to open with how I ended up where I am right now and sort of what's the motivation of why I work on energy and climate issues. And to me, it's this realization I got in my senior year of high school that climate change was going to be an issue that's really going to affect me for my adult life. And I was pretty sure that it was going to be ignored in terms of action that was going to be taken upon it for the first couple of decades. So I really have an AP environmental science teacher that I had to thank for that and drawing that connection that the science is out there, as this Mr. Olson presented to us, but actually a lot of the solutions, whether it's from policy or from technology innovation, would have to come from more than just the scientists. So that was a very big lesson I got in my spring semester of high school, actually. And it's really interesting. This is happening on March 27th, because if you can see here, about 10 years ago, I got this letter in my inbox that I got admitted to Tufts. And so as I was thinking between March and I think it's like May when you have to decide, I came to the decision that, you know what, Tufts is probably the right place to think about this interdisciplinary-wise. So in that spirit of, if I don't want to just be a scientist, how do I work on this? Tufts would be a good place for me to explore that. While I was an undergrad, two important internships for me. One, I worked with Rep. Barber for Somerville, Massachusetts State House. She's on the Energy Environmental Committee, so got to get more aware of how Massachusetts as a state supports a lot of the climate work. And then also got to do this internationally too, European Bank for Reconstruction and Development. So that's more development banking, international-wise. From Tufts undergrad, I got very lucky to continue here for an extra year. I went to the Fletcher School Law and Diplomacy, now Fletcher School Global Affairs. There, I was able to work on some more environmental issues, nonprofit, with CDP, so the world's largest company-related environmental data survey, as well as a consultant opportunity with the World Bank Group. And from that, I was able to bridge into a consulting firm, energy and environmental consulting firm based here in Waltham, Massachusetts for a couple of years called the Cadmus Group. Mostly initially to do international development energy work, but also from there got to do more energy and environmental technical consulting work too. And then finally, I ended up at this company, MSCI. So MSCI is mostly known for selling indexes to financial products in the financial services world. So they, clients will come to MSCI with investment ideas like, give me a way to invest in China, give me a way to invest in emerging climate themes, and we give them lists of companies, as well as we think the optimal allocation should be to that list of companies. So just because we give you a list of 100 companies to invest in, that doesn't mean $1 goes to every company, right? We might, based on our research, say, actually $10 should go to be the top company, and everything else should get like a couple cents and whatnot. That's most of what my company does, but I'll explain on the next slide exactly what my role is. I think for today, use me as an example of, again, recognizing there's plenty of jobs you can do beyond being a scientist. Recognize that your major at Tufts may not end up matching your job description later on, right? And finally, use me as an example of maybe what are some of the benefits of trying out different sectors early on in your climate career. You don't have to feel like, I want to do public sector, I have to go into that immediately. So these are some personal learnings along the way. What exactly do I do right now? So I work actually for our sustainability and climate business. So I don't work for the main index business that's creating investment products. Outside of that, we have three data offerings that we give. One is more like fundamental investment metrics called analytics. The other is private companies and real estate database. The third and final one is sustainability and climate that I work on. So essentially, we have about 10,000 sustainability and climate related data points on 15,000 of the largest companies in the world. And we write about what we can learn from this data set for the investment community. And we subdivide amongst researchers to different specialties to focus on. And so my focus tends to be on these topics: energy transition, climate risk, corporate emissions reporting, sustainability, disclosure regulations. And before we hop on, disclaimer is that what I'm talking about today are my personal opinions. They're not representative of the official viewpoints of the company. I might cite a couple of examples of our public research, but I'm coming at it from sort of my personal angle here today. What I want to do today, I want to split this talk into three parts. So the first part, I recognize that climate finance as a field can be a bit foreign to a lot of folks here. So I want to do some baselining, get everybody caught up with the typical jargon. I want to introduce three main concepts the field is also evolving in right now: transparency, materiality, and additionality. Then I want to pivot to do a bit of a thought exercise of how the public sector and the private sector have different ways of working on climate. In what cases can they work together well? In what cases do they limit each other? And I think this is a very good exercise for any students here as you're thinking about what your next step is. Where do you want to position your work? Where is the impact going to be? And also, let's also dive into why is this so frustrating and difficult, right, structurally. Thirdly, I am a recent alum, so I will share sort of what I think advantages are for being at Tufts, and how you can maybe translate this to your career after Tufts. So those are the three parts I want to get into. Let's dive right in. A word salad, as we heard earlier. This is often like a very fair, confusing critique of the sustainable finance world. There's so many acronyms, there's so many complicated terms. I will do my best to walk us through how they all come together today so that once you leave this talk, you can go investigate further different areas of your interests. But why does the financial services sector care about climate change, right? It goes back to that intro to economics framing of there's a market failure here. You learn in chapter 1 of your economics textbook that the market is a pretty efficient way of allocating resources. But we also learn sort of later on in that textbook that there are a couple of exceptions, right? There's going to be a market failure where the market forces don't distribute resources the most efficiently to solve for certain public issues, right? Public interest issues like perhaps climate change. And so the market is not pricing transition risks, such as the shift to a low carbon economy. So over time, we don't rely on fossil-based energy as much anymore. We go more towards distributed and low carbon sources. It's not pricing in that transition. And it's also not pricing in physical climate risk, whether it's an acute event, so that's the risk of hurricane, flash flooding, or chronic climate change, which is more heat over time or colder temperatures over time in certain areas. This might not be priced in correctly in the market today. If that's true, financial services needs to care for potentially three different reasons, right? The first goes back to how does the government usually solve for a market failure? They will enact regulation, right? So they will come in and say, okay, you can no longer fund this, you must fund that. They will give tax breaks, they will give different types of schemes, carbon pricing or whatnot. So that could be a reason for financial services and markets to need to react. The second is, even if there isn't any laws in place that require to them, their own investments might be adversely exposed and it's not reflected in their current risk planning. So if that's true, they also need to care. And third and finally, this is in financial services and investing, it's always about comparing to the benchmark, right? So if everybody else is making more money investing in something and you're not, that's a problem, right? And so if there are emerging opportunities that they're missing under the climate umbrella, then that's something they will care about too. But you can't talk about climate finance without a grasp of sort of key financial terms. And I share these not to say like you got to know these inside out directly, but I think it's helpful to give you a flavor of why it can be so tricky to make that bridge between, you know a lot about climate versus you need to talk to somebody in the financial world, right? So I'll go through a couple of these terms and then sort of circle back as to think about how does climate affect it, right? So if I have a venture or a company and I want to expand it, usually I want to raise capital. And I can do this a couple of ways. I can either offer you to buy ownership of it, right? That's usually equity, issue stock, or I can try to get a loan from somebody that I will repay, issue a bond, take on debt. I can do this in the public markets, or I can do this in private equity, private markets. So I can do this different ways, but however I do it, there's going to be different profiles of that investment opportunity I'm offering to somebody. There's a different risk, there's a different volatility, there's a different return profile, right? How do investors evaluate this? They look at your financial statements, and then they build ratios, essentially. So these are the common ratios you hear about of like earnings per share, earnings growth percentage per year, or like price to book ratio, right? These are the typical terms you might get thrown around when people are talking about like, oh, how much should NVIDIA cost per share, right? So that's how they build the valuation of a company. And so the key here for climate to enter into mainstream finance is how do you use climate with these terms, right? Is climate affecting the volatility of an investment? Is climate affecting, are there certain new ratios we should be looking at, like carbon intensity per unit of production, right? So instead of how much profit you're making per barrel of oil you are creating, do we also need to look at emissions intensity over barrel of oil or gram of cement, right? So there's different ratios that perhaps we can introduce to fix this market failure or address this market failure, rather, that we know is not being priced in. So that's sort of the terminology I think you have to be ready to engage with if you want to talk about this. And how do you engage with this, right? So again, this is a chart from MSCI research, so not my team, but this is what the global investable markets look like. So the global investable market opportunity is. That black strip right there is public equity. So that's stocks, which is, I think, what we mostly think about when we think about investing, private sector, whatnot. But actually, you'll see here, there's a lot of different what are called asset classes that exist throughout the investable universe in the world, right? So you have a lot of bonds, like fixed income. You're going to have real estate. You're going to have private equity, private credit, right? So that's like different vehicles. And all of these different asset classes, they have a different time horizon and profit expectation. So again, as we think about where is climate fitting in to their valuations, it's not always just about stocks, right? The opportunity or the risk sometimes is beyond just the stock market. And I think that's something to keep in mind too. In general, how do we think about maybe coming up with some metrics to speak to the financial services community? We can have it different ways, right? So I think the typical one is the carbon footprint. That's the one people are most familiar with, using a carbon intensity. We can try to project out some future impacts to a company, whether that's looking at their reserves, whether that's trying to look at a carbon budget. We can try to calculate their current exposure to climate, either risks or opportunities. So risks might be if you're a high emitting company, we think your risk exposure is high if you're also in a country that has high regulation of this. Or we can look at your clean tech revenue, right? We can say, hey, you seem like you're a leader in this space because you make the most money from battery storage in the US or whatnot. Physical or a transition climate. So this is what I'm going to give an example of the temperature metric, and let's look into like what it's good for, but also what it can't solve for, right? And I think that's the key here is that there's not going to be a silver bullet metric. You're going to need different metrics depending on the message, the research question you're asking. So portfolio temperature ratings. I think this gets talked a lot about in the media because it's like an intuitive alignment, right? We all know we need 1.5, we need 2. And so we come up with these ways to try to align. Can we say a company is on a certain emissions pathway? So how does this come together? Actually, what this type of a rating is if the world's emissions was based on this single company's trajectory, what trajectory would the world be on? All right, I'll say that again. So if the world's emissions was simply based on this company's trajectory, what trajectory would we be on? So you can start thinking about how that's an interesting exercise in some cases, but for other types of questions we're trying to answer about the real economy, it might not be that helpful, right? It's an important alignment metric, but maybe not in terms of actually modeling sort of what trajectory the world is on from emissions, right? So what are the key inputs here? You come up with some emissions budgets based on what sector the company is in. You look at what the company's projected emissions are, and then you could come up with these different terms, right? Are they Paris aligned? Are they 1.5 aligned? Are they 2 aligned? You get this term net zero, which is using the International Energy Agency's scenarios that says we are at a point where we need carbon removals. And so that's the budget they're using. That's where the net zero comes from. But there's a couple of key questions that this still won't help us answer, right? So on the one hand, this gives us a very comparable way to say, this company is on a two degree pathway, that one is not. What it can't answer for us is doesn't really help us in the bigger picture of the exact tipping points, right? As we know, like the climate systems in the world aren't like linearly growing in emissions in terms of reaching their tipping points. So like this still doesn't help us answer like when and where the disruptive effects of climate change are. Again, the relationship to the real economy, just because I shift away my portfolio temperature, it doesn't mean that company stops existing and stops emitting, right? And third and finally, this approach does not take into account who is developing climate solutions, right? So if I am developing a lot of low carbon energy, right, and that's not showing up in my emissions profile, I'm not getting like an additional bump for that. When in fact, we know that the energy transition requires more financing, more development of innovative climate solutions. So I think this is an example where, again, as you can see, even with these caveats, of course, most of the world's companies are not on the budget alignment pathway. You can see the stats here. I think only 11% based on our methodology here on the 1.5, and across all listed companies. So that's publicly traded companies. Not that many have set science-based climate targets. So that's sort of the world we're at right now when we use this exercise. But I want to encourage everybody to recognize that even beyond this metric, there's a lot more to think about in terms of what could we be encouraging in the private sector, and what should be the right metrics to evaluate companies on. One thing that comes up often is, yeah, you can do this, but can you do this for private companies, right? There's so many companies out there that are publicly traded. The story is pretty much the same here. Scope 1 emissions are mostly in utility, energy, and material sectors. That's true public and private. And most of emissions are concentrated there. So what does this mean, right? I've given you a quick example of a metric. We can try to use what it solves, what it doesn't solve. What are we looking at here? Well, we know from the UN emissions gap report that we're still on a 2.6 to 3.1 degree pathway. And on this pathway, we got to expect a lot higher adaptation costs. So the trend we are observing here is that, yes, there's more low carbon power that's becoming competitive, price competitive, but fossil fuels also aren't phasing out as quickly as the 1.5 trajectory would call for, right? So we're in this weird duality space now of some progress is happening where it needs to happen, but in other areas, there also isn't the phase out at the rate the 1.5 scenario calls for. And what this does put us on is this higher 3 degree pathway, right? So on this pathway, we should expect higher adaptation costs. So what I'm getting into here now is like how we in our research try to communicate what this means, again, back to the financial services sector, and where we're running into some ongoing challenges, right? So there's less consensus what this means to invest on adaptation versus mitigation. It's pretty easy to compare a ton of carbon, across the world. How do you value like the service of protecting this community versus that? How do you measure the value versus the returns? This will be a theme I come back to later, but the social value something can provide is often distinct from the profitability of something, right? Sometimes they match, sometimes they don't. How do you address that? How do you close that gap too, right? Is this where maybe public and private sector need to start working together to make sure there isn't that big of a misalignment? even if some of the more innovative examples right now try to use like AI agents to scrap for company descriptions that could benefit or have more business to do for adaptation solutions. If you think about that, that's from a more pure profitability perspective, right? So that's not going to be adaptation as I think the Tufts community would think about it per se, which is like which areas need the highest cost to protect. So throughout this talk, I'm going to keep outlining where there's going to be these slight differences in definitions. And I think this is very important for people listening here to think about how they can reorient and speak across that. How does ESG fit into all this? Because this is this acronym people love to throw out there. And since I am from MSCI ESG research, it would be sort of negligence if I didn't address this, right? But ESG is a sustainable investing approach that I think because it precedes a lot of the climate discussions, we can learn a lot of lessons from as we think about how to do climate investing the most effectively. So ESG, environmental, social, governance. So climate does sort of fall under its permit. This comes from a 2004 United Nations report. Basically, the premise is there's some intangible value out there in companies that's not on your profit statement that probably is material, right? So how well you treat your employees, how is your company structured, how high is your pollution footprint, these types of issues. And we can come up with some metrics in aggregate to try to rank companies against each other, right? But at the end of the day, what is this rating meant to do? It's to measure a company's resilience to these material risks, right? So they're not a general measure of the company goodness or a barometer on any single issue or a synonym for sustainable investing. So again, the more you create an aggregate signal, sometimes you have to recognize the value it brings, right? So we can flag if a company is about to lose money, potentially from certain risks. But in order to build an airtight definition around that, we might need to separate out elements of like the social impact or societal impact. So again, different metrics achieving different aims. Always important to keep that in mind. How do we do this, right? So we make sure we don't weight all companies on all the same key issues. We care more about the emissions of a utility company than we would of a lower footprint. We compare industries. We compare companies within the same industry against each other. That's our final letter grade rating. We have a universal rule that corporate governance matters for all companies. And also we say if you're higher exposed to a risk, we need to see higher levels of management for you to address it. So those are the 4 principles behind our rating. But what this means is this can, again, cause a lot of confusion when people are trying to use the ratings, right? So the common confusion is, can I compare an electric vehicle company's rating against an oil and gas company's rating? Intuitively, yes, right? But actually, what I just said of this rating is still based on within the industry, because that's how most financial services make investment decisions within an industry. The letter grade rating is actually not comparable, right? Can I write an academic paper that says it looks like emissions doesn't affect the letter grade, the overall aggregate rating? This seems like a big finding. Again, the use of the metric is causing confusion here, right? Because the input of a carbon intensity is like level 4 here in raw data. And by the time it rolls up to the aggregate signal, its overall effect on that rating maybe is not that high. So it's probably by design that there's not going to be a perfect correlation that you're looking for there. And then of course, I think the common one is that, can I use this to also do like a goodness rating too at the same time? And again, to build one metric for one purpose, it's hard to ensure that I can do that for both purposes. And so with that, I think it's very important to illustrate for the field in sustainable finance the difference between impact investing, which I think is what a lot of people mean when they say ESG and climate finance, and how most of the financial services industry would define it too. So impact investing, notice how this might align with sort of individual objectives or societal outcomes, but also where it doesn't, right? So oftentimes when a financial services company says, I want to have a climate investing strategy or an ESG investing strategy, they're talking about the left here, right? I want to use this data to enhance my profitability, my return profile. Oftentimes, I think in the media coverage of this, they're talking about what's happening on the right, which is values, right? So our investments should align with our values, or it has to have like some sort of a positive impact in the world. Is there going to be overlap here? Of course there is going to be, right? And we're going to get into that later on, where public and private sector overlaps can cause that. But I think fundamentally, whenever you're having a discussion or doing any research about this, you have to make this distinction very clear. Are you talking about value in financial terms, or values in terms of ideas? If you mix the two together, you're always going to be prone to some errors. So with that, I want to introduce these three terms, and hopefully we can dive into these bigger themes I've raised, and you can get a better understanding of our day-to-day work of what we're engaging in. So transparency, materiality, additionality. And I think as I'm going through these case studies and some existing research for the students out there, if any of this is like a potential thesis topic to you, like please get in touch with me. I think we very much want to encourage more people to engage with our data. Transparency. So I've been talking so much ad nauseum about metrics. It's pretty clear we need a common language, right? But how hard is this to implement? This is really tricky when you start bringing it in. So in Europe, probably unsurprisingly, they're the first ones that are trying to bring some discipline around all this labeling, right? So somebody calls ESG something, it means two different things to two different people. That causes a lot of legal problems. They come up with fun naming rules. But what happens when you tighten up the definition of ESG? When you look at the data, suddenly the number of money flowing into ESG is dropping, right? The narrative that emerges from that is, oh, people aren't investing in this anymore. But of course, that's sort of the trade-off you make when you tighten up the definition legally of something, right? So tightening up the definition maybe leads to higher quality of products that are labeled under that, but does that also mean overall numbers of funds flowing into that topic are going down? They also are trying to, in the EU, pass really broad sustainability reporting directives. This is giving very tight definitions of what you can qualify as like sustainable revenue, sustainable CapEx, and whatnot. But the bigger and tighter, the tighter and stricter you want to propose it, the stronger pushback you're going to get from industry, right? So what's happening now in the EU is that the implementation date, as well as the scope of companies it's being applied to, what's acceptable of being approved in EU is being hotly debated, right? So you can come up with the perfect system, but you're going to get this industry pushback of what you can eventually pass through legislation, right? So again, at that point, you have a common definition, but it's also watered down, right? So that's the trade-off sort of in the real world you have to think about when you try to push a legally binding definition. California. So this is very interesting, especially in this day and age when the SEC is no longer going to push sustainability reporting across companies. These two pieces of legislation are slated for next year, but essentially, if you are a large company and you operate, if you're a large company by that definition, 500 million revenue, and you operate in California, you have a variety of emissions and climate risk reporting obligations that are about to kick in, right? So again, a way to try to bring more transparency about how much are you spending on climate-related issues, how much exposure do you have to fossil fuels, but the courts can try to challenge it and hold it up. So legislation is one way to try to push it, but you can get into a lot of inertia. The other way people try to encourage transparency is to try to set a legal precedent. But in absence of any law around, misleading statements in your sustainability report, you only have sort of consumer protection claims right now. That's the main avenue to encourage more transparency. So you say a company has been misrepresenting their claims. But the main case here is that a financial services firm has been fined in the past because they sort of labeled their ESG products too broadly in definition when they weren't exactly following what they said their labeling was doing. But in another precedent case here in the US, Allbirds versus Dyer, the judge actually ruled, so the claim is that your carbon footprint calculation isn't like the most scientifically rigorous, and you can't say like the sheep that make your shoes are happy. Like that's the two main contentions. Like they say this is wrong, but actually this lawsuit got dismissed because Allbirds posted their methodology publicly. And also you're allowed to make some marketing claims if they're beyond what they can be proven wrong, right? So I think the lesson here is, again, transparency right now is key, but transparency doesn't mean uniformity, right? So Allbirds says we were transparent. There's no legislation right now that like requires our life cycle assessment to be done a certain way. We posted it and we followed it. That's transparency, right? So I think that's one interesting case to bring up about like what does transparency really mean, micro versus the macro way we tend to think about it of let's implement a requirement for everybody to report a certain way. Our own research. Okay, so transparency, how tricky this can be, right? One of my favorite pieces I got to work on last year, but we went through a lot of footnotes in company sustainability reports, and we found a lot of ways that emissions sometimes are excluded from company reporting. You know, this can be putting all your thermal power generation in a subsidiary and then saying in the footnote, yeah, this does not include that subsidiary. This can include, I have a business unit I'm about to sell, so I'm not going to calculate it in my emissions. Switch your accounting methodology, form a JV with somebody, right? There's a lot of ways we found companies are lowering their carbon footprint they report year over year. And again, but this is, in some ways, as long as they're footnoting it, they are being transparent about it, right? And it's up to sort of research, whether it's at MSCI or in academia, to actually figure out what are the implications and the actual risk the company still takes on from this behavior. So again, I think this is transparency, still very much an evolving field aspect of the field. Materiality, single versus double. So this is very interesting. Materiality in general, the concept is why does this issue affect the financial profile of my company? So whether it's emissions or a labor type of issue, is it material to me? Right. So the companies will often say this issue is not material to me, even if there might be a societal implication. I only care if it's material to me. And that's the difference between single and double materiality. Single materiality is we only look at what matters to the company. Double materiality is both ways. We look at how the company is affecting the world. And again, unsurprisingly, there's a US and EU difference here in approach and how they think about this. So the paradigm, single materiality, outside in. How is the company affected by the world? Double materiality adds the layer of how are you also affecting the world as a company. And right now, because of how fiduciary duty, which is a very big word that affects a lot of financial institutions, that they have to act in the fiduciary duty of their clients, basically to say they're representing the best financial interests of all their clients. Because in Europe, this is legally defined with a sort of more sustainable business element in that definition, there's a lot more room for them to consider double materiality approaches legally than in the US, where it's a much tighter definition. And so you see only a single materiality approach often that's discussed in the US. So that's sort of where we're at right now. But for companies, this can be very confusing because they have to report in the US and in the EU. And something you report as double materiality, what you as a company are doing to improve the world around you can be interpreted in the US as maybe against your single materiality interests, right? Why are you doing this if it's not helping improve the bottom line? So it's a very interesting tension that's emerging in the field right now. Materiality, like how exactly do the financial services people track this risk? So I think for the people that want to go directly into financial services after school, like this is definitely something to look up, the full paper, but like how do you take a risk? What's the transmission channel and how does it ultimately affect your market performance evaluation? I'm not going to go into too much detail about it, but just to sort of visualize, like this is the language that people use to take climate-related events. So whether it's, and then move it all the way to like valuation change. What I will highlight though is we did this systematically across different topics, a recent study we did. And a very interesting finding is on energy and emissions, right? So on the left here, we talk about, actually, let's start with the right here. So does better management of your climate change risks improve your market performance and your profitability? We found that this is mostly true across most industries, except for energy. So it's a very interesting finding, right? Because to me, it goes back to when we talked about market failure at the very beginning, which is there already a fix or an incentive like carbon pricing in place? When there isn't, it might make sense for an oil and gas company with a high carbon emissions footprint to be making outsized returns, right? So when we don't have a lot or very widespread carbon pricing schemes in the world, it does make sense that you see this huge red over here where there's like no correlation, or in fact, a reverse correlation of emissions intensity performance and the traditional energy sector, right? So that fits with also that narrative we talked about in the emissions gap report, where we know low carbon technologies are starting to pick up and be commercially viable, but fossil fuel also isn't phasing out on the 1.5 trajectory and pace, right? This sort of shows that story live in the stock performance. So I think this is a very interesting case of market dynamics matching what we know about the science too, and how it's all coming together. On the left here, I know it's a bit small, so I'll try to read it out for folks here. What we're trying to measure is what type of key issue drives outperformance. So if you're good at managing something, does it lead to outperformance and like higher return profile for stocks? And we find for the utility industry, the strongest factor is good carbon emissions management, lowest carbon intensity. So again, that goes back to there are low carbon technology opportunities that are becoming profitable now for a lot of companies, and especially in the power generation sector, we are seeing this pop up, right? You only will have a low carbon intensity if your power generation mix is of lower carbon sources, be that solar, be that wind, be that nuclear, right? That is what is lowering your carbon intensity, and we're finding a really strong correlation there. So very interesting finding to me as like the energy and utilities analysts when my colleagues put this out, because to me, it matches quite well with what we're seeing from the bigger picture climate trajectory reports too. Additionality, the final thing I want to go over here. So basically, you need to prove how additional each product you're offering is for it to have good value and for people to price it correctly. So the very common thing here is renewable energy credits, power purchase agreements. I think most folks here are familiar with that scheme, but you want to prove that it is actually because of this funding I'm giving you that this solar plant was built, right? You don't want it to already be a solar plant there and I'm giving you money for it. So that's additionality. It's because of my money, this project could be built. This is pretty well established now. We've had like 10 good years of tech companies building this industry out. So it's well established. So likely for a lot of those carbon removal credits that want to take off, they can try to replicate this. But it starts getting trickier as we talk about more ecosystem services and valuing that, right? So nature-based solutions, agriculture type of credits. And this gets even trickier to prove for biodiversity, right? How do we establish the right baseline when you don't necessarily have tons of carbon to measure, right? How do I argue that indigenous groups protecting this biome in one country is equal to these two rare species that are about to go extinct in another country? We have something called TNFD, for those that are interested to look up. They have 13 initial metrics to try to get into this, but I think we're, to be frank, we're still a whiles away from the industry having a consensus about how to value these ecosystem services. And this is key if we want like market incentives to be funding these sort of solutions, right? Briefly, I want to touch on public versus private sector. I've been talking a lot about how markets and financial services are thinking about their investment decisions, but this all relates together, right? So it's a messy exercise, but broadly, you have the government that's up there. They set regulations. They also provide public finance, right? The government can fund things. You have private capital, which is mostly what I've been talking about. And then you do have the technology innovators out there. And so I think in general, it's worth reflecting, who can provide what are the trade-offs, what does broader cooperation look like, and why does it often fail? And where are some spaces for effective partnerships, right? So we know these are the general relationships that the government can either regulate companies or they can provide tax breaks and tax incentives. We know that private companies ultimately are the ones that provide most of the capital for disruptive technologies and ideas to really commercialize and scale. But we know that the government sometimes steps in and offers those technologies and solutions some low interest loans or grants if they're aligned with what the government sees as public interest. And this all comes together usually with this term blended finance, which just means that public and private money at the same time are funding technology. But certain you have to think about here, if you're on the technology side, which I think is where most of the Tufts folks here are right now, we're not directly in public or private. There are different conditions of working with these different groups, right? So with private capital, they're going to have a profit expectation very soon. With government, you're going to have to show your alignment with whatever public interest incentives. With blended, you're going to have to respond to a little bit of both. And I think a challenge right now for that blended finance is that obviously public and private has such diverging interests sometimes. And so how do you create a compelling opportunity as a new climate solution that can speak to both? So that's really, if we talk about sort of scaling up the private sector involvement, these are the types of questions we really need to grapple with here. Piece I wrote in September, last September, Inflation Reduction Act. This is a great example of public incentive crowding in private investment, right? So we know that the Inflation Reduction Act offers a variety of tax credits if you invest in certain topics the government has deemed were relevant for national interest. And since then, private sector, as of September last year, had already poured in over $100 billion. So within a year or so, $100 billion has gone in. Mostly, we saw the large investments were to battery storage and EVs. And it wasn't just Tesla and First Solar. We actually found most of the companies that take on these tax incentives were large conglomerates, right? So the Toyotas of the world, the Hyundais of the world, the General Motors of the world. They were very active in this. We also saw a lot of international money coming in. And so when the tax incentives and when the government and private sector work together, you can really create a lot of new opportunities. You saw the battery, a lot of the battery plant announcements and the employment that was happening across the country. That's what can come of good public-private cooperation. Of course, now we have a different administration, and so the top question we get is, what does this mean? There's a QR code now. If you want to hear me and two other colleagues talk about this for 20 minutes, you can listen to the podcast there. But our take right now, I'll just quickly go through this. So on the clean tech side, it's very interesting, right? That slide before about tax credits and all the investment coming in, it requires Congress to repeal. And so you already see 20 House Republicans signing a letter saying, we don't want a full repeal of IRA tax credits. So sometimes the money, the economic interest there really can bubble up, right? So that tax credit still exists and money is still pouring in to those sectors right now because the IRA has not been repealed yet. Versus the DOE, right? The executive branch does have full control over the DOE. So a lot of the more innovative grants, the more frontier technologies, you see that's where a lot of the funding cuts has been. And so what we see on research at MSCI is this means that the more commercial ready technologies probably are going to be most resilient, onshore wind, solar. We also noticed that the industry, so outside of public sector, industry has a lot of big interest in geothermal and nuclear. So traditional oil and gas, they're very interested in developing geothermal. Tech companies are very interested in developing nuclear. So there's funding going to those two topics too. But EV battery, offshore wind, these two sectors that relied more heavily on public federal subsidy, those are the ones that are seeing the highest uncertainty and effects there. Very interesting analysis on the podcast from another Tufts alum who's now my manager too, our oil and gas analyst, Chris Cody. So he has an interesting take in this episode too about how US oil market share in the world has actually been growing 10 to 15% since 2020. And so he sort of throws out the question, is there really that much more room to grow in global oil markets for US oil versus US gas? So he provides a take there that actually gas is probably the part of oil and gas that in the US industry will continue to grow versus actually the oil. So that's an interesting, I think, contrast from what you might be reading. And don't forget, rest of world, right? The clean tech solutions continue to grow rest of world. Most of the clean tech supply chains, the leading companies can be in Europe or in China or across Asia. And it does have effects in the emerging markets, right? Most of the new energy demand from fossil is going to be in China and India. And for example, China's shift to electric vehicles, where now almost 30 to 40% of them are of new vehicle purchases or EVs, has created such a big dent that global oil markets have had to change their growth forecasts, right? So when they built those 5 to 10-year forecasts, they assumed that China would be a very strong driver of new oil demand because EVs has reached a critical amount of new vehicles that's actually cut into global oil forecasts, right? So there are broader dynamics at play we should not forget outside of the US too. Okay, talked a lot about what I've been working on. I'll offer some quick reflections at the end for how I think your Tufts career can help you. I think here we are. So let's see. Okay. Interdisciplinary toolkit. I think this is the strongest aspect of what you have access to here at Tufts, all the cross-registration, all the cross-pollination you can do here. I recognize that this is very hard to market to employers, and I think that's something you have to just be aware of as you're a junior and a senior. It's harder to explain to that HR generalist at a company what your liberal arts education prepares you for. So have some examples ready. Be thinking about that early and don't be surprised by that senior spring, right? But you do have a more diverse perspective than most other college grads. So have faith in that. Don't underestimate the soft skills, how and what to say when. It's an art, it's an ongoing journey. I'm still learning how to do this, but boy, does it pay off in work situations. And I wouldn't underestimate this at all. Like you can be the smartest person in the room, you have like the best ideas, you don't present it correctly, it might not be effective in the workplace. So do not underestimate like how you can develop this. And college is a great time to experiment with it. What happens if you mess up an improv show, right? Nothing really, people laugh at you, right? What happens if you mess up 5 years later in the workplace? Well, there's consequences then. So I think soft skills, don't underestimate what you have an opportunity now to develop that. Look, in the workplace, you got to be a lot more concise and to the point. But I think the detail-orientedness, the thoroughness you get to work on and research here is going to be an advantage in a lot of early career jobs, right? Because the main difference is going to be your manager is very busy and doesn't have a lot of time. You have a lot of time, but you don't have his expertise or their expertise. So keep that thoroughness, keep that detail-oriented, and sort of be ready to channel that early career. Job hunting, a lot of people reach out to me when they're seniors. And what I noticed, some common themes here is, do not underestimate the volume of applications. Like not 10, not 20, it's probably like 40 to 50 is much more reasonable. You have to be prepared for it. And that's a time commitment, definitely plan for that. Have some one-page work samples ready to go, whether that's from a class or an internship, have it ready to go that shows what your expertise is, what you can do. And build a clear answer to why me. It's pretty rough, right? Every opening that gets put out there now gets hundreds of applications, sometimes thousands. But it's got to be you, the individual, that gets it, right? And that you have to have that mentality of why you and a clear story there, not just I want to make the short list if you want to get the job. So really think hard about why you and build that into whatever application. Yes, networking is very important, but please think about how to do it engagingly, respectfully, and effectively, right? It's not just a transactional thing if you're asking for people to do it. So this is when I think back, like sort of how these things helped me out in my own career. As I mentioned earlier, I didn't realize advanced GIS would open up to a World Bank consulting opportunity. And that ended up when I was interviewing for my first job out of grad school, they saw that as a very clear hard skill qualification. They were like, hey, this guy can pull off a World Bank consultancy, he'll be fine. I took all these different classes in undergrad and different topics, right? But it helped me become a much better writer and critical thinker. It was actually Professor Bishara's anthropology intro class that really, she was very tough on my writing. Did not do well academically, but I improved a lot and I'm much better for it, right? Took a lot of political theory courses, also political analysis. So Professor Robinson, political science department, really helped me up a lot there. And she actually was the one who advised me to go to grad school and help me prepare for that Fletcher application. So you never know who you're going to run into as you're taking all these courses that ends up being a really important mentor for you, right? And the environmental law and environmental economics classes you guys have access to here are great because they're not necessarily required in other schools. Soft skills, I didn't know that debate in the US is a competitive activity and people go to summer camp for it, but I made myself do it and it helped me a lot to speak. Fletcher, the grad school here, if you can cross-register there, they have very good like negotiation type of training classes and you get to sort of experiment with different strategies in class. So I really value that, like as somebody that can be a bit more timid, like to try that in a classroom setting and that giving me more confidence to obviously apply that in the workplace. And even after I was in Boston for a couple of years and I did a mediation like weekend training that they ran. And I thought it taught me a lot about how to have difficult conversations in the workplace, how to deal with emotional conversations. So definitely, again, don't sell the soft skills short. Yeah, internships are the best to get ready for that adjustment. Don't underestimate, like you got to learn how to use Outlook and Teams and whatnot. Like that's just not something you learn in school. Yeah, practical job hunting tips, like the alumni can definitely help. As you can see here, alumni helped accelerate my interview process. And yeah, I was preparing for MSCI. Again, my degree, international relations, environmental science, is very much not financial services. So I reached out to a couple of my grad school friends who were from that background and said, hey, help me prepare for this interview. What should I try to know? Use the people use your network. It definitely can help. That's what I have prepared for today. If you want to stay in touch, that's my LinkedIn profile. That's my MSCI.com page. So that's where my writing is published. And I'll leave it there. I think we'll cut it there.